Welcome to the Commodities Institute podcast. I am your host, Emily Costa. It is Friday, February 27th, 2026, and we have a packed episode today as the global landscape for raw materials continues to face massive structural shifts. From the precious metals mines in South Africa to the grain elevators in Ukraine and the oil fields of the Middle East, the stories we are tracking today highlight a world where logistics, diplomacy, and supply-side constraints are colliding in real time. We will be looking at why platinum is hitting historic highs, how shifting seasons are affecting cocoa farmers in West Africa, and the strategic delays in Russian oil asset sales that are being used as leverage in high-stakes peace negotiations. Let us start today with the metals sector, which is seeing some of the most dramatic moves on the board. In South Africa, Northern Platinum has just released half-year results that are frankly staggering. The company reported a 25-fold surge in its profit for the 6 months ending in December. To put that in perspective, their headline earnings per share jumped from 0.61 Rand a year ago to over 15 Rand. This explosion in profitability was fueled by refined metal output, rising nearly 4%, and a basket price that increased by over 50%. The primary driver here is the price of platinum itself, which hit a record of more than $2,700 an ounce in late January. We are seeing a perfect storm for this metal. Investment demand is surging, but more importantly, the supply side is crumbling. Production in South Africa, which accounts for 70% of the world's output, has been in a long-term decline, falling from over 5 million ounces 2 decades ago to just under 4 million ounces last year. Analysts are expecting another 10% drop over the next 5 years. On the demand side, the European Union's recent reversal on the 2035 combustion engine ban has provided a massive floor for the market, as platinum remains a critical component in the catalytic converters used to reduce vehicle emissions. While precious metals are booming, the industrial metal space is also seeing a push for higher prices. Major global aluminum producers are currently in negotiations with Japanese buyers, seeking premiums for the April to June quarter. They are asking for between $220 and $250 per metric ton, which represents a significant jump of up to 28% from the current quarter. Even though domestic demand in Japan remains relatively soft, producers are pointing to very high premiums in Europe and the United States, as well as low inventory levels globally, as justification for the hike. Turning our attention to energy and power, we are closely watching a developing situation in Saudi Arabia. The state oil giant Aramco has been forced to take its Guaima liquefied petroleum gas terminal offline for repairs. This is one of the world's largest export hubs for propane and butane, and it is expected to be out of commission for at least a month following structural damage that occurred earlier this week. This is a major blow to Asian markets, particularly India, which receives about 60% of Guaima's exports. At least 10 cargoes scheduled for March delivery to India have already been cancelled. While this will likely tighten supply in Asia and drive up regional prices, it may open a window for United States exporters. The US currently has record high inventories of propane and butane heading out of the winter season, and traders expect some of that displaced Asian demand to shift toward American shores. In the corporate energy space, Italy's Eni has defied the broader trend of softening oil prices. They reported a 35% jump in fourth quarter adjusted earnings, bringing in €1.2 billion. While other European majors like BP and Equinor have been forced to scale back their share buybacks as oil prices averaged around $63 a barrel, Eni's strong performance in its exploration and production division has kept them on a growth path. They are actually planning to increase production by 2 to 3% annually over the next few years, bolstered by new projects in places like Angola, Indonesia, and Norway. Shifting to the world of agriculture, there is a massive recalibration happening in the cocoa market. Ivory Coast, the world's leading producer, is taking the unprecedented step of moving up the start of its cocoa mid-crop season to March 1st. Historically, the mid-crop begins in April, but the government is trying to get ahead of a growing crisis, Global prices have slumped, leaving Ivorian cocoa too expensive for many buyers and causing massive amounts of unsold beans to pile up at ports and inland warehouses. By reclassifying next month's production as mid-crop, the regulator can slash the price paid to farmers from the main crop level of 2,800 CFA francs per kilogram down to between 800 and 1,000 CFA francs. It is a painful but necessary move to align with the global market, following a similar price cut in neighbouring Ghana. The government is currently paying a massive subsidy of around 2,000 CFA francs per kilogram just to maintain the current guaranteed price, a situation the authorities have described as completely unsustainable in the long term. Meanwhile, in the soybean market, Brazil is continuing its dominance. Despite competition from American farmers, Brazil is expected to increase its exports to China again this year. Last year, Brazil shipped over 85 million metric tons of soy to China, capturing nearly 74% of the Chinese market. With Argentina's crop expected to be smaller this year and focused more on domestic processing, Brazil and the United States are vying for a projected 4 million ton increase in Chinese import demand. Moving into the dry freight and logistics sector, the situation in Ukraine remains incredibly precarious. While grain deliveries to Black Sea ports did tick up by 2% in the first part of February compared to January, the total volume is still trailing behind last year's levels. The state railway, Ukrzaliznytsia, has moved about 2 million metric tons of grain so far this month. The big hurdle right now is infrastructure damage. Constant attacks on railway lines and power substations are making logistics more expensive and less reliable. In Odessa, which is the heart of Ukraine's shipping operations, export capacity is estimated to be down by as much as 30% from pre-war levels. These logistics costs are forcing local businesses to cut their own prices just to stay competitive, even as power outages make their production increasingly unprofitable. Finally, we look at the oil market and the complex diplomacy surrounding it. Saudi Arabia is poised to raise its crude prices for Asia for the first time in 5 months. The official selling price for Arab Light could rise by about $1 a barrel for April. This move is largely driven by increased demand from India, as refiners there look for alternatives to Russian crude. Interestingly, at the same time, we are seeing the United States use Russian energy assets as a diplomatic tool. The US Treasury has extended a deadline for the sale of Lukoil's international assets. Lukoil, Russia's second-largest oil producer, has a portfolio valued at $22 billion that includes refineries and oil fields from Iraq to Finland. By slowing down this sale, Washington is reportedly trying to increase pressure on Moscow during ongoing peace talks regarding Ukraine. Any deal for these assets is strictly regulated. Lukoil cannot receive any upfront value, and all proceeds must be placed in frozen accounts under US jurisdiction. This sale has attracted a wide range of interest, from US majors like Chevron and ExxonMobil to private equity firms and even individual billionaires. That brings us to the end of our deep dive today. The common thread across all these sectors is a high degree of adaptability in the face of supply chain fragility and geopolitical tension. Whether it is a cocoa farmer in Ivory Coast or a platinum miner in South Africa, the global market is forcing a massive reset in how we value and move the world's most essential resources. If you found this episode valuable, be sure to subscribe, share, and leave a review.